Okay, so for today I will talk about the trading strategy and the fact that I reviewed all the data from what has been done so far, and I found some pretty important tweaks that I can make to the strategy that I already started following today. So before I was always looking for a break of structure. I found when running the data and the probabilities that I can actually do as well, if not better, if I simply enter a broken wing butterfly after the first 5-minute candle. And so what I'm choosing to do is, if the first candle is a decent red candle or a bearish candle, then I'm going to enter a broken wing butterfly that's bearish right away. If it were a bullish candle, then I would do the opposite. So here's how it played out today. Is I entered a bearish broken wing butterfly right after this candle. So it looked something like this. And so I put it on, and then of course immediately the market went completely against me, way up here, and then it gradually came back down. So this is where patience and just trusting the probabilities and the data comes in, and I just let it go all the way back down, and then it started looking good at about here, went back up, and I waited through all of this. I do have one thing that I can do in this trading plan if it's staying far into the losing area, and I'll talk about that in a minute. But so what happened here is it jumped up, and I thought there was a good chance that I was going to take a losing trade today, but then in the last 10 minutes it dropped down right. So this line was actually where my short calls were, and it was not quite at expiration yet, so there was a bit of a curve here. But I ended up taking 270 in profit. So that is 275. So that's pretty good for the market going completely against the trade immediately and then gradually working its way back. Now, several things that I am putting in this plan to add edge, or what I would perceive as edge for my trading plan. Again, everybody does what works best for them. I'm just talking about what I have found that works best for me. So if I put a trade on and it does the opposite, let's say this were a bullish candle and I had put on a bullish broken wing butterfly. So I would watch that, and if it got far enough into my profit area where it reached close to the daily average true range, that's part of this plan now. And so what that means is, so I would have put on a put. Okay, to simulate this, let's go to the next day. So I would have put on a put broken wing butterfly if this had been a bullish candle, and we would have just went up. So in Optionsmith, we have the option of showing these daily ATR lines, average true range, and that takes so the average true range is a calculation where we take the last 14 days, the highs and lows, and then we calculate based on that, or the open and close, whichever is greater. There's a formula that's a standard, but it calculates what the average range is that the price will move throughout the day between the highest and the lowest. And so what we do in Optionsmith is we have a calculation where we take the lowest price so far for that day, we add the average true range, and so we have this line here, and this is where I would expect, on average, if the price got up to this line, there's a good chance that it wouldn't go much farther than that. It always can, but in my plan, I look at probabilities entirely, and I assume that there's a good chance that it would turn around here, it would stay here or turn around. And so when it gets close to that point, if I see a decent candle heading back the bearish way, so if it were like right here, then I would add on another broken wing butterfly to create a bat wing. So it would look something, can't add another one with the draft, but it would look something like this, but there would be the peak over here, and then the profit area going this way. So the profit area, the runoff profit going this way would reduce some of the potential loss down here. This runoff would reduce some of the potential loss on the other side of the bearish broken wing butterfly. So then you have this Batman trade. And so the way that adds edge to the overall, I mean, that might not add much edge to the actual day itself, but it adds edge to the overall plan for me, because then it's essentially doubling the amount I would make if it lands in between the two peaks. And it also adds two locations on the chart where if it finishes with, if it gets to the end of the trading day and it's under one of these peaks, then I have a potential for a much higher profit. So those are the situations where, when doing this, when it follows that pattern, it can really add extra profit for that day, which, for me, the edge that happens is that that outweighs the losing days that I have even more. So it's a matter of creating situations when I can that create boosted profit, so that those add up when those situations work out, and then they offset losses that I take even more. So that's where I have found edge for myself. Of course, this isn't guaranteed to work for everybody or even anybody other than me, but I'm just describing what I have found works for me. So so there's that part of the plan, and then another part of the plan is if the trade goes against me and it's staying out in my loss area, and it gets to the point where it's out here. So throughout the day in Optionsmith, there's this bar that's it says the expected move, and this is calculated based on the premium prices at the money put and call options. So there's a formula used there where, based on what the options are pricing in, it's saying that the options are expecting that the price is not going to move farther out than this shaded line. It always could, but that's just what is being priced in. So it's kind of a good indicator of where probabilities are in that sense, how far it's going to move. And so part of my plan is, if the price gets way out here, and based on the expected move, it's not even expected to get back to break even, then I'm going to assume it's pretty likely that it won't get back to break even. And in that scenario, there's this thing I can do where I can add a short call right here where I've got the long put. So I would sell a call, and then right behind it I would buy a call. Now I can't add that while I have a draft, because you can only have 4 legs in an order, and so I can't pile on more than 4 legs. If I had this position on already, then I could add another credit spread. But just to show what it would do, and I'll maybe make another video when I actually have a broken wing butterfly in the market. What this does is it creates less of a loss area over here. Let me just put this back. So it creates less of a loss area over here. When you sell that credit spread, you're just reducing your cost basis and saying, okay, I realize it's highly likely I'm going to take a loser here. So I'm going to reduce this. So usually if it were 350, you could maybe reduce it down to like 250 by adding that credit spread. Now, if it did make it all the way back to your profit, and there's a reason why I would be putting that spread right inside this area, because if it does get back there, then you're not adding more risk to the whole overall position, because this profit zone then makes up for the area where you'd start losing on that credit spread if it got back to it. So that way, if it did land in here, you could actually still end up making a profit. I saw when I was trying one out, instead of like a $700 peak, where that's the most I could make, the most I could make was like $300. So it in that situation where the price is way out here, it's a lot less likely that it'll come back here. But if it did, you could still squeak out a decent profit. And on the other side over here, it does make this a loss zone, but it's a very small one. So you are losing all this area that I like to have for probability of the price ending up there. But since it's already way over here in that scenario, it's very low probability that it would end up over here. And again, I'm never creating a higher max loss than I already have. What I'm doing is I'm reducing what the max loss is at that point, because I'm saying the position is burned. It's going to be a loser most likely. So how can I reduce that risk over here? How can I reduce that loss without adding more risk anywhere else? And that's what I can do, is I can add a credit spread right there. So that's the basics of this plan that I've modified from what I was doing before. And it's also just a lot more of a hands-off approach, mechanical, because I'm not trying to constantly look for price action that's breaking structure. I'm not saying that wasn't a good plan. It still is. But this is sort of the more efficient way based on all the data that I gathered from doing the other plan. And so this is what I plan to stick with for now. All right, thank you.